Assalamu alaikum, everyone. This is Taimur. Sami is our presenter today. He will be talking about how to assess the financial health of the organization. I do not have the jargons that he will be using, so I will leave it to him to explain it to us as to how we can judge a company for wise investment. So, Sami, over to you, okay?
Thanks, Tamur. Salam, everybody. Basically, what we'll do today is like I'll walk you through a Form 10K. All the companies which are registered in the US and they are listed on the stock exchanges here in the US, they are required to submit this form with the Securities and Exchange Commission. So listed firms, they actually submit quarterly forms, which are known as 10Q forms. And then they also have an annual form, which is called 10K form. So this form basically covers the operations of the of the firm, the risks which are involved in this business, and then the financial information. So, I mean, just taking a step back. When I joined the group, our stock trading group, what I see in that group is that people, a lot of them, they talk about charting, which is like a different way of looking at stock prices and, investing decisions. Whereas the thing which I'm going to explain today is more like what a fundamental analysis is called. So in order to value or invest in stocks or, bonds or any other financial instrument, there are two different approaches. One is called the technical analysis, the other one is called the fundamental analysis. Technical analysts, they actually look at these charts, they look at price movements, they look at historical, moving averages and candlelight charts and all that kind of stuff. And the other way of valuing any company is known as fundamental analysis. Now, fundamental analysis is what you actually look at the financial information of the firm, and then based on that, you actually make your assessment about whether this company is it overpriced or underpriced compared to what the market is valuing the firm at a particular point in time. Now, the benefit of this analysis is that you actually understand the business a lot more. You are able to understand what the company actually does, what it actually wants to do, what the management intends to do over the next few years, and what are the key risks for an investor in order to, invest in a company. And then there is historical financial information, so you can look into that and you can understand that what particular, how much is the sale of the company, how much was the cost of achieving that sale. And then there are, other information which is available, that how much is the available cash balance, and then what are the obligations of the firms in terms of the debt it has to pay and all that. So that's what we are going to cover today. So to do the fundamental analysis, we actually look at the form 10K in, in US, they actually prepare this form, but in other parts of the world, they don't really submit a form 10K. They actually submit their consolidated annual financial statements and quarterly financial statements. The annual financial statements are more important compared to the quarterly ones because in the annual financials or in Form 10K, you will get a section which is called MD&A, which is Management Discussion and Analysis, which basically management writes and presents to the audience, which is the investors, regulators, and all those other people who are interested in covering the stock as to what they are doing and what they intend to do going forward. So that's their like plan. And it gives you insights about the operations and the business in general. So I'll quickly walk you through this 10K and then I'll show you a valuation model. So the stock I've selected today is American Airlines. And the reason I selected it is because I recently did a valuation for that. So I have that model handy. So that's why I thought it's better to, just go through that. So this is what a Form 10K is. It mentions here what is the name of the company, where the company was actually registered, then what is the title of the class of shares, common stock. When the company issued it, it was for 1 cent per par value per share. What is the trading symbol, which exchange it is listed, which is here, the NASDAQ. And then we'll quickly move down to scroll down from here. And all this information, if you have time, you should read it. It's good to understand. But if you come to this table of content, so some important sections which any investor or anyone who is valuing a company, they will actually look at are the items mentioned here. What is the business? What are the risk factors? This unresolved staff comment is something which you will not find in all the 10Ks, but business risk factors, properties, legal proceedings, all these other sections you will find in most of the 10K forms. Then, if you come to the section 2, here you have the financial information that the company will talk about, that where the company is listed, what is, do they have only common stock, they have preferred stock, and all these kind of different stock options, different stock types they will talk about. Then there is consolidated financial information, which is the income statement, which tells you how much income a company generated. So when I will go to that section, I'll explain to you what an income statement is. Then here you will see management discussion and analysis of financial condition and results of operation. So in an MD&A section, management generally provides a commentary on what happened, how did they achieve those results, were there any problems which they encountered during the year to achieve those results, and what are the future, goals they want to achieve, and what is their plan. The plan would not be in a lot of detail. That would come in as a supplementary information in the analyst call, or if it's a private company which is valued by an investment bank or by an investor, then they provide that information separately. And then you have some quantitative and qualitative disclosures from the management on the market risk. And then you will see here 8A and 8B, you will find the consolidated financial statements, which is the income statement, balance sheet, cash flow. Then, if you scroll down further, you will find information about the company's management, who are the directors, executive officers, what is the executive compensation for these people, and the rest of the information about the firm. So, I will first walk you through the business. So here in this section, they talk about what the company is like. So they talk about what is the company, is it so they mention where it is incorporated, how many subsidiaries it has, and like American Airlines Group AAG, it has several subsidiaries which form the corporate entity, which is the American Airlines Group. So they have mentioned about it over here. They also talk about when the company was founded and where is the principal office located. And then they talk about here in the second part, what is the operation? So what do they do? How many flights they operate? What airports do they cover? So this kind of information about the business in general is provided here. So as this is an airline, you will see this information for the airline. But if it is, let's say, Tesla, you will see in this section what Tesla does. And they are car makers, and then they are getting into energy and all that kind of stuff. So they will talk about it over here. Then this section is mainly about the business, so I won't spend a lot of time about it. So they are talking about their cargo operations, their distribution and marketing agreements, their alliances, joint ventures, marketing relationships, and all that stuff. Then the next part is the important one where they talk about their industry competition. So they talk about their what sort of competition they are facing. So this is an airline, so it faces competition domestically and internationally. This section, I mean, the way they have written this section, it might be different from the way a bank will write it, or some other entity will write. But the core of this section is that they have to provide you with a commentary about the business operations. So you learn more about the business. So that's why when Warren Buffett says that in his spare time he reads 10Ks, this is what he reads. So he scans through all this information, understands what the management wants to do with the business, what is their goal, and whether they are achieving their goals or targets or not, or how will they do it in the future. And then by looking at this information along with the financial information, he makes his inference whether he should invest in the company or he doesn't. And if he has any follow-up questions, or any investor has any follow-up questions, they try to gather more information from the company. So a lot of times you can go and talk to the investor relations people at the firm, and then they can provide you with the information. You will find information in the press. And if you are an affluent investor like Warren Buffett, then you can just talk to the CEO and the chairman of the company and learn from them what their plans are. So this section mainly covers this information. Then I will go to the risks. So here they are talking about the key risks of the business. So the very first one they're talking about is that the business is intensely competitive and dynamic. So there, as we have seen, that due to COVID-19, the airline industry has suffered quite a lot. So they actually talk about all these risks which they face, and this section generally covers that. They have talked about, availability of the aircraft fuel, the pricing of the fuel, then availability of, finding space at busy airports, because if the airport is busy and the airline needs to circle around it, and they are burning a lot of fuel. So in order to save the cost, they try to have efficient ground handling services, and they try to operate at different airports where they do not need to spend a lot of time in the air, and they can land quickly or take off quickly. So all these risks and different things, they are actually mentioned over here. Then unresolved staff comments is something where you will see some information about. It doesn't really appear in all of the in all of the 10Ks, but you will find some sort of information. Sometimes the company is facing an employee lawsuit, and they need to provide that information over here. In terms of property, so since this is an airline, so they are talking about the aircraft, how many aeroplanes do they have, how many they own, how many they lease, and what's the total amount. Then they will also talk about their other equipment which they have. So all these things the firm needs to provide, and this information is key for you to have a look at before you make a decision whether you should be investing in the company or not. Then if we scroll down, then item number 3 is basically the legal proceedings. So here they are talking about their cases. So Chapter 11 cases are basically related to bankruptcy. So they are talking about their, previous bankruptcy which they filed in 2011, which was as a result of the previous financial downturn. So here they will talk about all of that. Then if they don't have any safety disclosures or anything, so they covered this section. They provided as much information as possible to the reader so that they can, understand the business and the industry, and then, make their inference. Coming to section 2, here they are talking about, where they are listed, what is their symbol at the date of, publishing this document, what was the price of the share, how many shareholders were there, then what's the dividend they paid, stock performance graphs. So this kind of information the firm will actually share, which is mainly, like a snapshot at a particular point in time to the end users. Uh, then they will also talk about any restrictions, if there are any restrictions in owning the shares of a company, or if there are different classes of shares. They will talk about it, and they will explain to the reader what's the difference between all of them. The most important section in a 10K for someone who does valuations and he works in an investment bank is to actually look at the consolidated financial information. So here the company is providing not only the information, but they are also breaking it down in different ways and forms, and they are also comparing it with different years. So for a reader, it becomes a lot easier to look at what was the company doing in 2015. The revenue was $41 million. In 2016, it went down to 40, then increased to 42, 44 and a half, and 46. So you can see that the company is actually growing, in terms of its top line performance. Then operating expenses are like the cost of doing the business. Net income is the total income which is attributable to the stockholders in the form of dividends. It is after deduction of taxes and after deduction of interest and all that. So this is the amount of profit which is to be given to the shareholders. So this is how you will see the information. Now the management is also providing some commentary over here. So it is good to have a look at this. But if the most important part is this section, which is the actual financial statements, which is 8A and 8B. So here in the actual financial statement, the first and the foremost thing is to actually read this letter. So this 10K form and the financial statement which American Airlines presented over the last year was actually reviewed by an external auditor. So when the external auditor reviews the financials, they actually give an opinion. So that opinion is actually provided in the form of a letter by the accounting firm to the company CFO, that we have reviewed your financial statements and we think that they are reasonably presented as per the accounting standards, blah blah blah. So they give that information. So the most important thing for you is to see that the document says that they have that the auditors have an unqualified opinion. An unqualified opinion means that they do not see any problem with the financials of the company, and they believe that the financials are as per the accounting standards and there is no misrepresentation or anything. But there can be a qualified opinion. A qualified opinion is an opinion in which the auditor says that we have reviewed your financials, but we found these issues. Now, some of those issues can be, very minor and can be, just like some understanding which the firm has different from the audit firm, and the audit firm will mention that you should represent this financial information in a slightly different way. It is not, as per the current accounting standards, so you need to change that. Or it can be a severe kind of opinion in which they can say that these financial statements, they do not make any sense, they are against the accounting standards. So we need to read all of this and make sure that the opinion is unqualified. Qualified opinion firms, again, the qualification which the auditor gives is something which we need to figure out whether it has a significant impact on the operations and the going concern nature of the business, or it is something which you do not need to worry about that much. So but still, it's good to have a look and read this part. Then, if we scroll down, so here the company is talking about, so this is again a continuation of the audit. So here they mentioned about few items which they felt that they need to fix, and the name of the auditor is here at the bottom, KPMG LLP, and they mentioned that since when they are the auditors of the firm. Now, coming to the financial statements, there are three types of financial statement. There is one financial statement which actually captures the sales, the cost of doing those sales, the interest expenses, and the taxes. So this is basically the statement of operations. In simple words, we call it the income statement, because what it is showing is the last item, which is called net income. So that's why it was known as the income statement. But now, due to a different convention, they are calling it consolidated statement of operation. Then I will come to it quickly, but let me just show you the second one, which is here. It is called the consolidated balance sheet. Now, the balance sheet is of a particular is of a particular point in time. It tells you that what were the assets of the company at a certain cutoff date. So this is December 31st, 2019. So as of December 31st, 2019, the firm had $280 million of cash in its bank accounts. So it is of a particular point in time. The income statement is consolidated starting from the first day of the financial year of the company till the last day of the financial year. Balance sheet is actually of the last day of the financial year in a 10K form. In a 10Q form, the income statement will be for the 3 months starting from the start of the financial year till the end of the first quarter, and the balance sheet will be from the start of will actually it covers the period from the beginning of the financial year, but the date of the balance sheet will be the last day of the quarterly filing or the end of the quarter. um, Cash flow statement is basically a representation of income statement and balance sheet items in a different format. so that you can figure out that how much the company generated cash during its operations for 1 year during the course of the year, how much cash it used in its investing and its financing activities. So that's what it says, but it is actually prepared from the income statement and the balance sheet. Now, I will go through the income statement quickly. So here they are talking about, since it's an airline, so they are talking about the revenue. So they are saying the passenger revenues, which is like the number of people who flew multiplied by the amount of money they paid in order to fly the airline. So that contributed to $42 billion in 2019. Cargo is the revenue from the cargo operations, and then this other revenues are like revenues from other different business segments. I will not get into that detail. And as a sum total, you will find this total revenue, which is $46 billion for the firm. Now, in terms of the cost of operating an airline, so the one of the cost is airline fuel and the related taxes. Then it is the salaries, wages, and benefits of the cabin crew, of the pilots, of the ground staff. Then they have regional expenses, which are like operating at different airports. You need to pay charges to the airport for using the airport facilities like landing, parking, gates, all that. Maintenance, materials, and repairs, other rent and landing fees, uh, aircraft rent, how much they are paying for the rental of an aeroplane if they've rented it, selling expenses, depreciation, amortization, any other items and others and all that. So this classification of operating expenses, it varies from company to company, but basically it actually tells you about the the expenses they are incurring in order to run the business. So depreciation and amortization is one item which is like more of an accounting expense, and it's not really like an actual cash expense. So you're not paying any cash out. It's an accounting entry. We are saying that if I'm using an aeroplane, the aeroplane as a useful life is actually decreasing, and as a result of that, I need to charge an expense in my income statement, and that's why we do that. Then non-operating income. This is like other income which firms usually generate. So for an airline, it can be. So here they're talking about the interest income. Then they have the interest expense on their loans, and then they have other income net. So all the net accounts are basically that there is like an inflow and an outflow. So they net it and they present the net position. So here, other income is presented as a positive item, so that means that this is adding to the income. If this was a negative item with these brackets, then that would mean that this needs to be subtracted, right? Then you come at your income before income taxes, so which is this 45.7 million minus 42.7, you arrive at $3 billion. So this is your operating income. Then from your operating income, you add this, you subtract this, and then you add this, you will arrive at 2256. Here they have presented it like they have broken this calculation down. So they have just calculated as after operating income, they have calculated total non-operating expense because interest expense is huge. So instead of becoming an income, the net impact, if you add all of this together, it will be negative 809. So they are calling it as an expense. So this minus this amount gives you income before tax of $2.2 billion. Then you have your income tax provision of 570, and your net income is $1.7 billion. So this is for this year. Now this information is only for 2019. We can do a very quick trend analysis. We can look at what's happening in 17, 18, and 19. So it was 39 billion. It went up to 41 billion. It went up to 42 billion, which shows that the company over the last 3 years, it has increased its revenue, it has increased its operations, and it is now, growing. Then you look at your cost. So the cost is also increasing, which, you know, over here. So it is also increasing. So this also shows that the company was, I mean, we do some more analysis, but I will not get into that detail right now because that would be too complicated. for some of you people. So I will not get into that, but generally speaking, uh, this provides you a trend analysis and you can see what's going on. Normally, what we do is we divide all these numbers from with the total operating revenues to see what is the percentage contribution of each of these items in terms of revenue, and then we look at which item went up, which went down, to see where we can save some cost, what is happening with a certain trend and all that. So we do all that analysis when we do a detailed valuation. Then same thing with net income. You can see that the net income is increasing over the years. That means it's a good business. But how much we should be paying to acquire the share of this company is the question. And that's what we need to analyze. Then some of the analysis is already provided. Like here, what they have done is they have provided what is earnings per common share, what is basic. Basic earning is total number of share outstanding. So you have your total net income, $1.686 billion. You divide it by your total number of shares outstanding, which is this number. You will arrive at $3.8 per share. Diluted is basically you have stock options, you have preferred shares, and other items which you actually convert into a common share. So when you do that conversion to present it, so the total number of common shares actually increases, and then you divide this number by these shares outstanding. So you will arrive at 3.79. So the reason of providing this information into basic and diluted is to tell somebody that if the company is to, if they convert all of their convertible debt into equity, and all the stock options are vested, and then you calculate what would be the earnings per share. So it comes out to be slightly lower. So they have to present this information not only for the existing shareholders but also for those shareholders who can become shareholders in the future due to triggering of a certain event, or due to conversion of some convertible debt security into equity. And then they also mention how much was the cash dividend they declared per year. So it was 40 cents. They have maintained it over 40 cents uh, in the last 3 years. Coming to the this is some more information on over here, net income and what is the other comprehensive income. They have taken some pension items out of it, and they are saying that the total comprehensive income is this much, but it's fine. I mean, you can look into this. This becomes important when there is an M&A transaction. Then you look at what could be the potential impact of pension, retiree, retiree medical and other post-retirement benefits on the transaction amount, that how much money I need to pay to acquire a company. So I will look into this in detail. But for a normal stock investor, if they look at net income, that is more than sufficient to have a look at. Then, if you move down, you will find balance sheet. Now, balance sheet is basically it provides you information about three items. What are the assets of the company, which is how much cash is there? Do you have any short-term investments? How many planes do you have if you are an airline? And then it provides you information about your liabilities, which is the amount which you owe to somebody. It includes loans and accounts payable, salaries, all that stuff. So that is covered there. And then you have your non-current liability. So so both these assets and liabilities, they have a current portion and a non-current portion. Current portion is basically anything which has a maturity of less than 1 year, that is not that is current. Anything which is a long-term asset is known as non-current. So, for example, building is a long-term asset because it lasts for several years, but cash is a current asset because that is, it has a limited amount, and now you use that cash to fund the operations of the company and for your other purposes. Same thing is with current liabilities and non-current liabilities. So there is um, so there is a, let's say if there is an airline and they take a loan for 10 years, so they will show 10 years. So on day one, they will show all the loan as a long-term loan on their book, on their balance sheet here, long-term debt and finance lease. So they will mention all the 10-year amount here. But after Like the first day after they took the loan and they have to create a balance sheet, they will move whatever is the amount due during the first year. They will call it current portion of the long term debt or current maturities of the long term debt, and they will put that portion here and the remaining 9 years in the long term portion. So that's how we do these adjustments. And then the last portion of the balance sheet is the shareholders equity, which is made up of your common stock. Then there is additional paid in capital and other comprehensive losses, etc., retained earnings, and this all creates an equity account. Now, there is a balance sheet equation, which is assets is equal to liabilities plus equity. This is like a universal truth. It has to be like this. You cannot change this equation in one way or the other for your computation. Yes, like if you deduct asset minus liabilities, you will have whatever is remaining is your shareholders equity, but this equation remains same. So if I change the equation uh, to some different form, it won't work. Assets should always equal to the right hand side of the balance sheet should always equal to the left hand side. This is like the American way of presenting balance sheet, but if you look at the British way of presenting balance sheet and some other nomenclatures which people use across the world, they take assets on the left side and they take liabilities and equity on the right side. So then the both sides actually balance out. So we call it in that format as well. Then, in terms of assets, I said they are current and non-current assets here. So you will see cash. So this shows what is the amount of cash as of December 31st, 2019. This was the amount of cash as of December 31st, 2018. What are the short-term investments which the firm has, which have a maturity of less than 1 year? What is the restricted cash, short-term investments? What is the account receivable, aircraft fuel supplies, etc., prepaid expenses? So then you have a total current assets. Then you have operating property and equipment. So this is long-term asset. So here you have your flight equipment, which is your airplanes and other related stuff, ground property and equipment, equipment purchases, deposits, and then you have a total of this. And then you have less accumulated depreciation. So since these long-term assets, they are used over a long period of time, so the accounting laws actually allow us to make, a deduction every year based on a certain way of calculating depreciation, and we can deduct that and we can reduce the value of these assets, and this depreciation expense every year, whatever we are charging as depreciation, it is deducted from the income statement before the tax. So it actually gives you a tax shield advantage, and you actually, it is like a way in which you reduce your taxable income, and then you pay your taxes accordingly. Um, then you have other assets. So since this is an airline and it acquired a lot of different other airlines, so there is a goodwill which arise as a result of those acquisitions. Then they have these intangibles, which can be, a patent, a right of flying to a particular destination, a route, or anything. Then they have deferred tax assets and other assets. I will not get into detail of what a deferred tax asset and these things are, because that is like a lot of accounting there. So I'm just presenting to you that what a balance sheet looks like and how you should read the information. So the sum total of all the assets is this. So it's $60 billion are the total assets for American Airlines. Now, what are the liabilities? This is the amount of money which they owe to other people. So you have your current maturities of long-term debt. They have to pay around $3 billion in long-term, in short-term debt in 2020. Then accounts payable. Then their accrued salaries, air traffic liability, their other liabilities. So sum of this is around 18 billion. Then we scroll down and we come to the long-term liability. So the long-term liability has their long-term debt, the loans they have taken from the banks, and then the finance leases which they have taken on their aircraft, like they have leased the aeroplane either directly from Boeing or Airbus, or they have taken it through a third-party leasing company. So they owe them this much amount of money as of December 31st, 2019. Then the pension and post-retirement benefits. So this is like an obligation which the firm has. As and when people will retire, they will get their money from the firm. But as of date, as of December 31st, this was the total balance of the pension and retirement benefit. Then again, loyalty program liability. It is very specific to an airline industry. So it is basically like if I fly American Airlines and I accumulate all those miles over a period of time, those miles have an expiration date. A lot of times, these expiration dates are 3 years, 4 years, 5 years down the lane. So, whatever is current for this year, they will present it as a current loyalty program liability. Whatever is like for the remaining years, more than 1 year, they will put it over here. Then we have operating lease liability. So the leases are of different types. So there is an operating lease, and then there is like a finance lease. I won't get into the detail of that, but that is the information which is captured. So the total liabilities, non-current liabilities, or the long-term liabilities are around $42 billion, and this is $18 billion. And then we look at the shareholders' equity. So the shareholder equity for this firm is actually negative. Why it is negative? Because of this accumulated loss which they have for from previous years. So as a result, when I look at this, I will see that there is a negative shareholder equity. So for an airline, it is fine to see this as a negative item. But if you are looking at a bank and there is negative equity, you'd never invest. If there is an other company which has a negative equity value, again, it's a big red flag. You will not invest into that company, because if a company has negative equity, that means that it is having significant financial distress. Airlines are a bit different because of different accounting standards and like different regulations from the government. They can carry on these accumulated losses and don't take them out of their balance sheet, and they keep showing their loss here so they don't need to pay taxes. A lot of this is like accounting gimmickry which accountants and the companies do. But for people like you who are not, a lot of people who are who don't understand accounting, who don't do valuations, a lot of times for them I would say that if they see a company with a negative equity, they should try to stay away from it, because it is like a risky investment. It can go up, it can go down, so you never know. So just try to refrain from that. If you are a risk averse investor, if you want to take risk, you can do that. So this is the balance sheet. Then we will come to the cash flow. So the cash flow is basically telling me three types of cash flow. So the cash is coming into the company and it is going out of the company. So there is cash flow from the operating activities, like which are the core operations of the business, like the airline. Their job is to take people and cargo from one place to another. So if they keep doing this activity, the amount of cash they generate, that is called cash flow from operations. But there is also cash flow from investing activities. Like, okay, I have like $5 billion excess cash. I invest it in a bank. I earn interest. That will be my cash flow from investing activity. And cash flow from financing activity. So the cash flow from financing activity is the amount of money I am raising from investors. It can be an equity investor who invests equity, or it can be a debt investor who gives me a loan. So all that is captured over here in this part. So we'll quickly go through it. So net income is basically from the income statement. This was my total profit for this year, $1.686 billion. Then I am adding back my depreciation and amortization. As I said, depreciation is like a non-cash. It is just an accounting adjustment. We are adding this money back because we deducted this 2.318 billion from the income statement. So we will add it back, and then we will deduct some other items and add few items to come at my net cash provided by operating activities. So what is important in this analysis is to we looked at the net income in the income statement. Now I want to see that how much cash the company's operate is generating from its operating activities. So it used to generate something like 5 billion in 2017, went down to 3.5, then went up to 3.8. So which shows that on average it is around $3.5 billion cash generating business. So which is good enough but not excellent enough. For some other companies like Apple, you will see this amount to be crazy. Like they will make a lot of cash through this activity. So it varies from company to company, industry to industry, but it has to be like, like in a reasonable level or bracket. It shouldn't be like in one year you are making 4 billion, next year you are making like 5 million only. So then it's a big red flag. So then you will be like, what happened to this company? What happened to the operations of the company that it went down from 5 billion to just $5 million? What happened? So you need to understand. Then cash flow from investing activities, they are talking about the capital expenditures which they incurred in order to purchase aeroplanes and all that. So they are spending a huge amount of money every year to just buy new aeroplanes. So you will also read some of the stuff which is related to like how many aeroplanes they are, purchasing, and then what is their plan in the MD&A section. But here you will see the financial impact of it. Then proceeds from sale leaseback transactions. These are like complicated transactions in which what they do, an aeroplane company, they actually get into an agreement with the aircraft manufacturer in which the aircraft manufacturer allows them to sell, they actually allow them for a sale, and they purchase the aeroplane and then they lease it back. So it is like a complex transaction. I won't get into the detail how it actually really works, but there are some of the items which are here. So uh, to understand, for your understanding, cash flow from investing is basically the amount of money the company is investing either in buying new assets to do its operations. Like if it's a manufacturing company, let's say it is like Tesla. So are they building a new factory? If they are building it, that will be cash flow from investing activities, but it will be negative because they are putting in money to produce that factory so that that factory can later on manufacture cars and batteries and all that stuff. So that will be their cash flow from investing. Here it's an airline, so they are talking about that, aircraft purchases, sales and leaseback arrangements and all that stuff. Cash flow from financing. So what they did, they issued long-term debt. So they issued a bond and they got this money. So they took like $3 billion here, $2.3 billion here, and $3.96 billion here. Payment on long-term debt and finance leases. And then this is what they paid off. So they raised this much amount as new money, and then they paid off this much. Then deferred financing costs. These are like some of the costs which they are deferring, maybe interest, maybe lease interest, or a commercial debt interest. Then treasury stock repurchases are the shares which they have purchased. So that is over here, dividend payments, other financing activities. And then you have your net cash used in financing activities, which is over here. So negative balance over here means that they are spending more money in their financing activities, like they are paying back more than they are raising more, which is a good sign. Now, the sum of this operating cash flow plus this cash flow from investing plus this will give you the net increase or decrease in cash during the year. And then you have cash at the start of the year, 1st January 2019. Then you add this $4, and then your closing cash balance is 290 million as of 31st December 2019, end of day. Now this cash from here to 290 million is the starting point on your balance sheet. So the balance sheet cash should be 290 over here. Sorry. So these three financial statements are actually linked, and the information from one actually flows to the other. Net income from the income statement, which is the very first statement which anybody creates, this actually flows into the balance sheet and it also flows into the cash flow statement. Then you have uh, items from your cash flow statement, which is your cash balance. So they did some calculations over here also. So cash and restricted cash at the end of the year was 290, but they deducted 10 million for the restricted cash. So it is total cash available for them is 280. So this 280 is what you will see over here in the balance sheet. So the closing item on the cash flow statement is the cash flow number, is the amount of the cash which you have, and that becomes the starting point of your balance sheet. So all these financial statements, they are sort of linked, and the information flows from one to another. Now, as an investor, if you are looking at these financial statements, I would say that if you don't have an experience or expertise in accounting and finance, then look at these statements as three different statements. You can get your idea of the profitability of a company from here. If the company is making loss, you will figure out that the company is making loss or it is making profit. So you can look at this net income number. Then, if you want to see what is happening with the total assets and liabilities of the company, so you can look at this part, which is the balance sheet. You can read the balance sheet and understand, okay, how much cash it has in and how much short-term investments and what are the liabilities. So you can understand all of that. The key red flag here is don't look and invest in companies which have negative equity. Now, this statement I'm saying is with a caveat. A lot of these tech startups, which are like, new companies, you will see a lot of them having negative equity. So when Google first started, or when, some other firms started, for a very long period of time, these companies, they had losses and they had negative equity. But then suddenly they started to become profitable. So with these kind of companies and investments, you should definitely look and understand these businesses more before you make an investment. But if it is a stable business going on for several years, like Pepsi and Coke, if they are showing a negative shareholders equity, then I'll be very concerned with their business and, with their share price and whether I should be investing in them or not. So, and to understand how much cash the company is operating from its operations, I look at this number. How much cash the company is generating in total, I look at this number, and this number over here, which is the same, 290, 290. So these are the three statements, and this is how you actually, go and read and understand them. And after these statements, you will find something which is called consolidated financial statement notes to the consolidated statements. So all the items which we saw on those statements, they are the management will provide explanations over here. Like we saw short-term investment. So they are talking about what are the short-term investment. They are in available for sale and held for security maturities. Then we saw about, like the long-term equipment. So they are saying that aeroplanes engines have a 20 to 30-year life, building and improvements of 5 to 30 years of life. So they are providing all these information over here. Why the goodwill, was mentioned in their financials, they are talking about it over here. What was covered in other intangibles, so it was provided here. So to read these financials, the 10K form, to understand a company, you have to read the 10K form from A to Z, because you are spending your own money and it's important to read it and understand it before you make that investment. Now in the group, I've seen people, there are few people who know about what they are doing, like, and Temur also mentioned that to me, that these people, they know and they understand what they do. And a lot of the thing of their investment is actually based on the technical analysis, which is the analysis of the price movements. So that is one way of investing, but that is not the solid way of investing. People do make money. Hedge funds, they do both. They do technical analysis, they look at that information, they also look at this information. But for them, in order to make a concrete investment, when they are like a long term investors in any company, they read this 10K forms and they do their fundamental analysis. They don't just look at, those charts and all that. Charting and technical analysis is basically for people who want to, make a quick buck out of that very quickly. Like they look at a price movement and they make a decision there and then. It goes up by $1, they exit, and then they make like $100 or $1,000 per day, and they are happy with that. But that is a very risky way of doing investments. So I would say that people who feel that they understand technical analysis, better than this one, I would still recommend them to read the company and understand what the company is and where they are investing. Right now, it is a bullish market in US and also in other parts of the world. So that's why people are just, going up and up and up, and they are seeing that portfolio returns going up and up and up. But I have seen three different times where the markets actually crashed. So when I was working in Pakistan, there was this one guy who invested 8 million rupees of his retirement money, and it went up to like it doubled, and the guy didn't pull it out. And then it was the financial crisis of 2008. And instead of having that 8 million of his own money, he ended up paying 2 million to the brokerage, additional amount from his pocket to, to get out of that trade. So it can go bad very quickly, it can go down very quickly, very fast. So be very, I would say, do your due diligence before you invest in these companies, but look at the price movements. It is good to do if you are trading within a 2 hour window, like you have 2 hours of spare time and you want to like make a bet and then exit from that trade. You can do that. But if you're a long term investor and you want to invest in a company, I would say don't do it on just technical analysis. Do your fundamental analysis and then invest in that company. I do understand that it's very difficult for people who don't have an accounting and a finance background to actually do the valuation of the firm on their own, but still you can read the 10K form and then you can understand about the business. So a few days ago in the group, there was this discussion going out about Tesla being a tech firm. Tesla is not a tech firm. Tesla is an automotive company. They got the momentum because they were the first ones who, went big time into energy, into electrical vehicles and all that. But still, there are companies like Toyota, which is like the world's largest car maker, and they are still saying that electrical vehicles is not the new thing. They still believe that hybrid technology in which you have a gasoline engine which is powered by the kinetic energy recovery system, like when you're driving a car and it has that curse system in place, that they put a battery in, so that curse system charges the battery and then the car can drive further on that hybrid system. So they are the proponents of the hybrid system. But then you have the likes of Tesla and Lucid and other car makers, Neo, the Chinese company. They are all into these electric vehicles. So, but at the end of the day, Tesla and these firms, they are like car makers. They are not tech firms. Tech firm is Apple. Tech firm is Cisco and all that. So there is a misconception going on. Smart investors, they don't really invest in these kind of things where people talk about, oh, Tesla is a tech firm, or this is not a tech firm. They do their own analysis by reading 10K. So definitely take some time out. It will take you like a couple of hours to read it, but it is worth it to read this and then make an investment. So that's what we had for the financial statements and all. Now I will quickly walk you through a financial model which I prepared for this American Airlines. So all this information which you will see over here, this is the amount of effort which goes into actually value a firm if you want to value it properly, instead of just looking at the price information. So this sheet which you will see over here is the information which I took from S&P Cap IQ. It provided me with the historical financial statements, now income statement, balance sheet, and cash flow for American Airlines for the last 10 years. So I looked at the last 10 years financial performance to make my model, and then I did my analysis based on that and the valuation of the firm accordingly. So this is a key stat. This is downloaded straight from S&P Cap IQ. Then you will have your income statement. This is S&P Cap IQ. It's just a quick download. Excuse me. Then you have your balance sheet, which is here. Then you have your cash flow statement. Then you have your multiples. These are like different ratios which are calculated by S&P, but we look at
I'm
them.
sorry to interrupt you, Sami, but are you
Yeah.
sharing something? Because I'm actually seeing the old screen.
Oh, okay. Let me just do the new one. So here is the model. Can you see it now?
Yes, I can. Thank you.
Okay. So I'll walk you through again. So this information, all of this is basically taken from S&P Cap IQ. So you will see this over here that this is Cap IQ information. It takes like 2 minutes to download all this information from S&P Cap IQ if you have access to that. So these are like the key stats about the business, about the total revenue, gross margin, EBITDA margin, which is earning before interest, tax, depreciation, and amortization. So EBITDA margin is basically the amount of profit you generated from your core operations of the business. That's why whenever you are valuing a firm which is for profit, you look at your EBITDA numbers because that's what the core operation is generating. Anything other than EBITDA, like EBIT, now I have taken out depreciation and amortization from EBITDA to come to EBIT. So and I know that depreciation and amortization is an accounting adjustment. It's not the actual cash which went out. So these are like some key numbers which you will find straight right off the bat from S&P Cap IQ. Here you will see the income statement, you have balance sheet, then you have cash flow. Here are the multiples. So these numbers are like calculated by S&P. They calculated it. You can look at them if you feel like, and if you have access to it. But I calculated these for myself in a separate sheet. Then you will see this is historical capitalization of the company. I won't get into detail of that. Now, this is important. The capital structure. Capital structure is how much of a company has debt in order to, in its capital structure. So, what is capital structure? So, you have assets. Assets are like the buildings, aeroplanes, cars, vehicles, laptops, lights, all this stuff which you use to actually run the operations of a company. So, in order to buy these assets, sometimes you take money from the bank or you take a loan from somebody else. So, that is called debt. And equity is your own investment, what you invest from your pocket. So, equity and debt, these are two key terms. So, total debt, if you look at them, so they had huge amount of debt over here and their equity was negative. And this trend continues in airlines because they are very cyclical industry. They went go up for 3 years, and then when a recession comes, it goes down. Same thing is with the automobile industry. Automobiles are also associated with, like a better performance when the economy is doing good, and they are associated with a bad performance when the economy is going down. Same thing is with steel and with, construction and these kind of industries. Other industries such as the food industries are considered to be like pretty stable, very stable in the sense that, if there is a certain amount of people who live in a population in a particular country, they will keep on like consuming food, so their earnings will not be affected that much if there is a recession. But if there is like like economic growth and more people are coming into that country like tourists and all that, so their results will be better. So there some industries are cyclical in nature, the others are not. Insurance tends to react in an opposite manner to the economic recessions and gains. So when it is an economic recession, it is a good time for insurance stocks. And when it is like an economic growth, it is a bad time for the insurance stocks. So this is how some of the industries they behave. Um,
For me, there's a question. Can you look at the question? What does negative equity mean?
Negative equity basically means that the company, so as I mentioned, you have assets is equal to liabilities plus equity. So let's say your assets are less than your liabilities. So now you bring your liabilities to the other side of the equation and you have, let's say, $100 in assets, and then you have $150 in liability. In the liability, I mean, make it simple. Liability is the bank loan. Assume that it is the only liability. You have a bank loan, so your total assets is now $100 as a result of loss making operations from since history. So now you have $100 left in cash and you have $150 in debt. So now you deduct 150 from 100, you will get negative $50. So now your equity becomes negative 50. So the loss making entities, they tend to have negative equity when they consume all the other profit related like accounts. I mean, I'm just trying to find the correct word in a simpler English. So basically, there is a retained earning account. So if your total earnings are lower than then your total liabilities, then it becomes like a negative equity. And if you want to, so I can just write it here very quickly and show you my example. So you, the way we write it is like assets is equal to liabilities plus equity. Okay. So if your assets are, let's say, 100 equals to 115 liability, and you have equity of, let's say, $10. So when I will further, so this was the positive equity, but then I used like $10 of my equity to pay off my liability. Normally, this is not what happens in these kind of businesses, but in banks, this is what happens a lot of times. So you will have now 100 equals 140. Sorry, let me just make it 0, otherwise it will confuse you more, or make it 10. So what I will do now is, like, there are two ways of looking into it, or I can, if I move this $10 of equity here, so this becomes 110. This is not equal to 150, right? 110 is not equal to 150. So then what you will do in case of a liquidation, you will pay $100, and still there will be for $40 of money which you are owing using this example, right? So there is $40 of money which you still have to pay back to the bank guys, because you took a loan of 150, and your total assets and your equity, which is the amount of money you invested in the company from your pocket initially to start the business. So both of them, they are unable to pay back the loan. So then what will you do? Then you will get into a financial trouble. You don't have cash, so you will file for bankruptcy. So negative equity arises when your assets, so if I change this equation, then 100 minus 150 equals to my equity. So then it becomes, so I have $100 in assets. My assets are not sufficient, or the amount of cash which I have is not sufficient to pay back my loan of 150. So my equity, when I will adjust this equation, the equity will be equal to minus 50. So this is what negative equity means. So equity should, it has to be positive, but sometimes in tech businesses, when they start, you will see negative equity in the sense that the company will take loan or convertible money from venture capitalists. They will take, preferred debt from them, or preferred stock, or depending on the transaction. So if they take debt, then you will see that the equity amount would be shown as negative, and that negative equity amount will actually show two things: a, either the company is having a lot of financial difficulties, and going forward it is not going to survive. So these are like two things which you take as an inference for yourself when you actually read that negative equity. But coming to the startup scene, so the startups, they have this tendency that several times that they have negative equity on their books, but that is a startup, that's understandable. But again, whether it's a startup or it's a going concern company which is there for a long period of time, if there is negative equity, it is highly risky investment. That's the key takeaway. If you see negative equity in a company, be very risk averse and do not invest in that unless you get more information about the reasoning behind why the company has a negative equity, and then you can make your decision. But if I see negative equity in a company, I look at it more closely and try to understand why is that happening. So from an investment perspective, we look at it from different angles. We look at whether we can buy a company which has negative equity and it is loss making, and then bunch it with our portfolio of profit making companies. So the overall incidence of tax for us is lower. So there can be different reasons why people still invest or acquire a company which is loss making or not. There are businesses, private equity groups, which are turnaround private equity. They love to buy these companies with negative equity, so that they can turn them around, make them profitable, and sell them at a higher multiple and make a lot of money. So, but those are like specialist investors. I would say that if you are not into that league and you don't do this, on a daily basis, invest in companies, then I would suggest that you stay away from it. Then, moving forward, I will quickly, now walk you through the model. So all this information is from S&P Cap IQ. Then I not only gathered the information for American Airlines, I also looked at the information of its competitors. So these are like some adjustments which I made. I will skip them because this model I need to adjust. So I will then go to other sheets, which is like the other comparables. So I not only looked at American Airlines as one of the company which I wanted to invest, I also looked at its comparables. So United Airlines, what are they doing? What is their financial performance? How are they operating? What is their profit? Are they having negative equity or not? If they are not having negative equity, then why American Airlines is having negative equity? So if you look at it, their common equity is positive. So this means that there was something wrong with American Airlines, and it's not, something which is affecting the entire airline industry. So it is affecting one particular company in the industry. So I need to now figure out what's going on with that. So these are the analysis which you do and you try to figure out. So I looked at United, I looked at their cash flow, then all these other numbers and sheets. Then I looked at all this again. I made some adjustments because I was doing some analysis. So I made some accounting adjustment and created adjusted income statement balance sheet for my model. Then I also looked at delta. So I looked at their profit margins. I looked at their financial performance. That what are they doing, what are they doing which American is not doing. So I look at these financials and these numbers, and then I identify that even these people, they had negative equity for a couple of years, but now they don't. So they are actually a very strong firm which has like $15 billion in positive equity. And in American, we had negative equity of 118 million. So this shows me that if I'm looking at this airline group, American is not the ideal company to invest given this kind of information. But then when I'm making my pitch, I know that American, because it's having negative equity and there is like, room for the management to improve the efficiency, and then they can reduce some cost so that their, profitability increases, and that profitability then results in positive equity. So I will then, look at American in a lot more detail from a different angle. And then I will look at what is the press release coming in from the management, what the management is saying in the earning call. Are they telling that they have plans of restructuring or they don't? Because if they don't and they continue to operate the way they were operating with a negative equity, to me, American Airlines is a useless company to invest. I will rather than, based on this information, I will look at Delta. That Delta is an awesome company. It has so much positive cash which it is generating. It is in the same industry. It is one of the largest. So in American airline industry, American is the largest and Delta is number two. So, and they have like neck to neck, they are neck to neck. So, why should I invest in American? I should invest in Delta. It is a better airline with strong financial performance and strong, fundamentals. So, I look at that. Then I also looked at Southwest, that what is Southwest doing. And I went through all this information. Again, Southwest, you look at their equity, how much total equity they have. Again, it is positive, but it is less than Delta. So just looking at these items, I would say, okay, so for me, American, it has problems, but other airlines, they do not. And then I will look at their income statement. I will look at how much margins they are generating, how big are their operations. So when I'm looking at Southwest here, I see that their biggest revenue is jump was in 2019 and they made only $23 billion. So that shows me that in terms of overall operations, Southwest is a lot smaller compared to Delta, United, and American. So do I need to invest in a smaller airline? Should I or should I don't or should I or I shouldn't? So I do these all these analysis and review this information and then make my investment decision based on that. Then I looked at all these other numbers. I will now go to the again here for this airline because I was doing my projections. So I looked at their financials in a different way. I made some accounting adjustments to understand more about the business. I calculated all these ratios, margins, EBITDA margins, liquidity ratios, and all this stuff. I calculated just to understand the operational efficiency and of all these airlines. So if I look at this, so in terms of gross margin, my gross margin over here was 27%, and my total net profit was 3.68% for American Airlines in 2019. If I go to United, their gross margin was higher, it was 34, and their net margin is 7%. So that is also good. Then Delta, they were 27, but here they were making 10% net profit margin. So with all these numbers, Southwest appears to be the best with 31% here and 10% in net profit. Now, which one should I invest? Now, it's not only like these elements I'm looking at, I am also looking at all these other ratios and the other information which is in the 10K. I'm looking at the absolute size of operations. And then what I realize is that Southwest, it's a smaller airline and they are, like a budget airline. So that's why they are having a higher profitability. But now, when I read the 10K of Southwest, I understand that Southwest doesn't have international operations. But Delta, American, and United, they have international operations. So should I go and invest in an airline which is only, majority of its operations are within the US or to a few select, destination outside the US? Should I invest in that company or I should not? So these are like, all these decisions which you make as an investor while you are looking at these financial statements. So I did some analysis here, got some charts and graphs, excuse me. Going over here, I looked at their financial leverage, which is the amount of debt and the amount of equity. So this ratio tells me financial leverage is basically your total debt divided by total equity. It shows me the higher the ratio, the bad it is for the company. So it shows me that American has a lot of debt, United has less, Delta has even less, and Southwest has the least. But now I look at these numbers and I compare it with the other information which I have, and then this is like an additional item which I need to, look at before I make my decision whether I should be investing in it or not. And these are like some of the 5 year stock performance charts. So I looked at this information as well. So when I was doing this analysis, that was like in March this year. So I could see that American, the trend is actually going down and down and down. And at that particular day, it was trading at $14. United, it was doing good, but then due to coronavirus, it got a big hit and it went down. Then I looked at Delta, same story, and Southwest, same story. However, of all these companies, the company which lost the most value compared to like 5 years ago what it was and what it is trading today, American again appeared to be like a worst company because it was 70% down in terms of share price what it had 5 years ago. And then United was 45%, Delta was 33, and Southwest was only 10% down. Now, this also shows me one important thing if you are looking at charts and graphs only, that more or less Southwest trades in a very limited band, right? So it was 5 years ago was trading at around 35, 36. Now again it is trading at 35, 36. In the best years when the economy was really booming under Donald Trump, it went up. But more or less, it's like, if I draw a chart like an average, it will show me a rising trend until here, and then it will show me a collapse. So more or less, I would say that the big jump I can get in terms of share price movement is like if I buy American now at $14, what if it goes back to 48? I'm going to make a lot of money. If the same thing happens with United, it is trading at 32, it goes up to 59 or this peak, which was for 100 or something, then I will make a lot of money. So that is now another piece of information which I need to look at. But if I invest in Southwest now at 36, the maximum I'm getting is what, like 60? I might not make a lot of money in this because I know that Southwest has an inherent limitation when it comes to like its operations. Now here I gathered all this information about the index. I did some calculation. I won't get into that detail because that would be too complicated for you. And here, so I all these sheets which you see over here, this one, this one, this one, and this one. So all the sheets from here, this, and this. All this analysis, all the information here is used to calculate just one number, which is the beta number, sorry, for American Airlines. This. So I did it in two ways. I used Excel and I did it using this format, like this descriptive statistics. And then I did it in a finance manner in which we actually run the regression and then we calculate what should be the beta. So beta actually tells me that compared to the market, how my stock is performing. So it's a measure of variance, and it tells me that all you guys are engineers, you would better understand what a beta is. But it is telling me that compared to the S&P 500, American Airlines has a beta of 2.04, which shows that American uh, outperforms the market. If it is going up, it will outperform. It will. So if the market yields one, American will yield two, but it's not the same with the other ones. So from a growth stock, from a big jump in the future earning, I can have a look at it. It also tells me the riskiness of the business. So I look at this and I understand, okay, so this business is like really risky. And then, I need to decide whether I want to invest in this or not. Now, the cost of the capital, which is another thing which we use in our analysis. So we calculate the weighted average cost of capital or WACC. This is the cost of equity and the cost of debt, which the investors are investing. This is basically the opportunity cost of debt. Like if the lenders don't lend us, they lend it with someone else. How much cost, how much money they will get from that. So there is a opportunity cost which we try to calculate here, and the same concept is applied to the equity investors, and both of them put together they yield a weighted average cost of capital, which is over here. So for me, when I was doing this analysis, I looked at these betas for all of these firms, and then I used certain formulas and I arrived at my cost of capital. So for American Airlines, their cost of capital is around 7.6%, and then their cost of debt is 4.2, but their cost of equity, because it is negative equity, so it is very, very high. So as a result of a high cost of equity and a lower cost of debt, we were able to get a blended amount. And here is which is around 7.6%. So their levered cost of equity, as I said, that this company, because it was like having negative equity, their cost of equity is 13%, which is very high given, the American economy, that the lending rate at the moment is actually, really low. It's near to zero. And it's been the case for the past year and a half. So I look at this cost of equity, and this is again something which I need to look at, that okay, 13% is the cost of equity for this business. So it is actually showing me the riskiness of this business. And I, look at it and I'm like, okay, so let's see what this yields me in terms of the valuation. Then we look at these. So I did some quarterly analysis and adjustments. I won't go into that. So in order to do a fundamental analysis, you do the valuation of the company. So in order to do valuation, there are three ways of doing it. One is called DCF, discounted cash flow method. In this, what we do, we take the historical 3 year or 5 year financial statements. We look at the trend and the growth and all that, and then we calculate something which is called the projected financial statement. So we project their income statement 5 years or 10 years down forward, and then we do the same thing with the balance sheet and with the cash flow statements, and then we calculate something which is called free cash flow. Free cash flow is the amount of cash which is available to a company after it pays off its the cash for running its operations, and then or all other obligations, and then this free cash flow is the amount of money which is available, or the amount of cash which is available to pay the holders or lenders, and also to the equity holders or the shareholders. So that's what I'm trying to get to. So to do that, I'm using these different assumptions. These are all my assumptions, and I used all of them to actually calculate my future balance sheet and income statement. So we had information until December 31st, 2019. So based on these assumptions and the historical information which I had, and all the other information, which is non-financial, I made some assumptions and I used those to calculate these numbers. So I projected the income statement, and here is the balance sheet. Right. So I did all of that, and then I calculated my DCF. So DCF, I took earning before interest and tax from this projected balance sheet for the next 5 years, and you took it here. Then I'm using my marginal tax rate, at what rate this company is getting taxed. I'm getting then my tax affected EBIT after that. So these are like like set formulas that you have to take EBIT, and then you add depreciation and adjust working capital and capital expenditures to arrive at your free cash flow. So that's what I did. And as I said, free cash flow is the amount of money which is available to both. Sorry, it says MasterCard. I I valued MasterCard, and then I copy pasted that template. I didn't change the name, but it is for American Airlines. So then based on this analysis, and these are like set formulas, I won't get into a lot of detail of that. So I said that this is my free cash flow, right? And then I calculated something which is called the terminal value, which is over here. So terminal value is that these are for the 5 years which I projected. And then I'm saying after year five, the total amount of cash flow which the company is generating is this, which is called the terminal value. And this is perpetual, this will be forever. Okay. So I add all of these together. So this is the present value of the cash flows, these ones. All these are these numbers. So if you add them, you will get 8.9, and then you have this number over here, and then I add my terminal value, I arrive at the enterprise value. So enterprise value is the total value of the company. Total value of American Airlines was $42.7 billion. And then out of this, I have loans of 34 billion. So I will deduct these loans. And then I had some cash on my balance sheet. I will add this cash back to this number. So I will deduct this from this and add this to this. So after that, I get my present value of equity of around 9 billion. So for me, the value of American Airlines was around 9 billion. So based on my analysis, the share price should be around $20 per share. So when I did this analysis, based on all these projections and numbers, I was forecasting what would be the value of the share of American Airline by December 31st, 2020. And I did this analysis in of this year, like 30th of March 2020. So I wanted to project what will be the value of the company as of, based on all this financial information and the information I gathered from 10K, what should be the value of the firm. So based on my assumptions and all this information, the number which came to me was something in the range of $17.4 to $24. This was my base case. Okay. That's why it is yellow highlighted. So if you look at the share price of American Airline now on, as of today, so let me just check it quickly. So my base was between 17.4 to 24.17 if I write AAL in Wall Street. So it says that American airline closing price today is $16.4. So when I did this analysis, the company was trading at $10. So I should buy this company because I believe the share is undervalued. Based on my analysis, the company is valued minimum $17.4 per share. But at that day, the price in the market was only $10 and some cents. So I did that for like my work, and we invested like $1 million in this stock at at $10 and some cents value, and now it is trading at 16.4. So whatever is the upside, we made all that money already. If we liquidate that position now, we made $5 a share straight away after the fees and all that stuff. So this is what I got from this analysis.
Sami, thank you very much. We are running over the time. कुछ questions हैं. एक
Hmm.
question है कि जी, once you are finishing, can you do 1 minute recap of most important 2 or 3 items to look at? Um, and then another question by Muhammad Rafiq. People who can't do this calculation by themselves, is there a place on web where we can get these reports?
So okay, so 2 3 points I would say is whenever जब भी आप invest करते हैं in this in this kind of business, I would say the most important key takeaway is before you spend your money, and if you are doing that technical analysis and you believe that you are fine with that, but still I would say read the 10K. 10K से आपको बहुत सारी information आती है and you are able to understand the business and the operation more, and that is really really helpful for you. So read that before you make an investment. Secondly, in the 10K, read the operation section. Don't, I mean, if you are not into these technical things, then I mean, just very quickly check if the auditor opinion is qualified or unqualified. If it says qualified, then that's a red flag, so you have to be cautious. If you try to understand what it means by qualification, it is written in the 10K, so just try to understand that. And yes, so the 10Ks are available on SEC website. I'm just reading another comment and then I'll continue. So there is a site, so if you write Edgar in Google, it will take you to the SEC database. Edgar is the database which has all the 10Ks. And then you just type in the name of the company and you will see all the historical 10Ks and 10Qs and all that. But the difference between 10Q and 10K is that 10Q doesn't have MD&A section. 10K has the MD&A section, and MD&A section is where you will understand more about the business, and the management is talking about the risk and the operations and how they make money and what they want to do with the business. All that information, the strategic info is there. Then you should also read the financial statement. That is the second takeaway. So the three financial statement, when you read the income statement. Yes, that's right. sec.gov/Edgar. So when you read the financial statements, look at the income statement, look at the revenue. If the revenue is showing you like a growing trend, like it was $1 in 2017, $2 in 2018, and $3 in 2019, that is good. That means that the company is growing. Then look at after the revenue, look at the net income. If the net income also increasing, was it like maybe 10 cents, now 15 cents, then 15, and then 20 cents? If it is 10, 15, 20, then again it is a growing trend. This is also good. Then you go to your balance sheet. In the balance sheet, look at the equity value and look at the total amount of debt. Equity value should be positive. If it is positive, that's another check sign. That's good. And then you look at your cash flow statement. I would say, I mean, for you guys, don't really need to look at cash flow. It is for people who do like little more advanced analysis. So they have a look at cash flow. But if you just want to look at cash flow and just to understand, then look at again cash flow from operations, cash flow from investing, and cash flow from financing. These three items. So if you look at cash flow from operations, and again, if cash flow from operations is growing, that means that the company is generating more cash from its core business, right? Cash flow from investing and cash flow from financing are like a gray area, because sometimes when companies they don't generate a lot of cash from their operations, they tend to borrow money, or they take money from their investments. So this is how they try to make up their cash. So that is another red flag. And then after you look at these financial statements, look at the risks which are mentioned in the 10K by the management. That is a key. This analysis, actually, I did it in a very detailed form, but there are some quick calculators which you will be able to find on internet. I tried finding some, but they were like again a bit complicated ones, and I was like, to explain to you guys those calculators, and then I need to explain to you where to put in certain numbers and all that. So I would say it would be difficult for you to do your own valuation, but I recommend that you read the 10K at the least. And then, um, so this is like one way of doing the valuation, which is DCF, the complicated one. This is the easy one, which is the multiple based. So here, what you're doing is, I mean, you can look at these multiples. These multiples are available on S&P Cap IQ, Yahoo Finance, all these different sources. You will find all these multiples. So, two multiples which are very important when you do a multiple based valuation are the ones which are related to this EV to EBITDA multiple, and then this price to earning multiple. So here I calculated my high, mean, median, and all that. Usually we take the median. So I will take 2.6x EV to EBITDA multiple, or EV to EBIT, or price to earning multiple, whatever is the median multiple, and I will multiply this number with my with my EBITDA of the business. So like what I did over here. So I had a bigger, like comparable pool of companies, and then I took out some of the airlines based on their business descriptions and their size and all that. So I was like that the real direct competitors of American Airlines are these three companies: Delta, United, Southwest. And then I took their median multiples, all of these calculations, the same one which I did over here, I put them here. And then I calculated my company valuation based on this method. So this is called the multiple method, comparable company method as well. So here what I looked at the EBITDA for American Airlines, which was 5.871 billion, and my median multiple, blended multiple based on all the analysis which I've done over here, it was 2.7x. So I multiplied this number by this. So this is my enterprise value, or the value of the total company. And then I deducted what was the debt on the book, and I added back cash. So it gave me a negative value of equity. So this means that there is something wrong with the multiple, but it gave me an indication. So I did this analysis. And then on the high side, I also looked at this 2.8, and then I did that analysis and it gave me negative value. So my note over here is that due to significant debt on the balance sheet, we will not use EV to EBITDA, we will use price to earning multiple. Now, what price to earning multiple does? Now, the price to earning multiple is basically looking at your net income. So net income is after you pay your, uh, your uh, uh, your creditors. So you pay back your lenders, and then you pay back your interest, and then you look at how much of the profit is left. So that profit is then used to calculate your numbers. So here I looked at the price to earning of American Airlines, which was the net income on the income statement, and I multiplied it with my multiple. So this gave me a valuation, the total value of the equity. So price to earning multiple is the equity multiple, and EV to EBITDA is the total value of the firm, and then you deduct your total amount of debt, and you add back the cash, and then you arrive at your equity value. But this one, PE, is actually direct. So you will find your PE multiple of the comparable firms. You can, I mean, if you are looking at Tesla, then what I can do very quickly is like look at all the competitors of Tesla, take all their PE ratios, take the high, median, low, average, and then apply the median multiple with the net income of my company. So this is simple. This is very straightforward. So my net income for this year was $1.686 billion. Multiplied it with the blended multiple, I got my equity value, which is around 6 billion. And at that time, based on this analysis, the share was trading at $10 and some cents. Value I got was around $14, and the high was around $17.5. So this is what my information at that particular point in time told me. So I felt that my share is undervalued in the stock price, so I should buy it, and that's what we did. We acquired it for $10 and some cents, and now it is 16.40. And this is another thing. It is again comparables, but I will not, go through this for you guys. Very quickly, we looked at previous mergers and acquisition transactions, and we looked at, we only looked at the airline acquisitions and what companies airlines purchased, and if there was any airline which was purchased by someone else, and we looked at their deal multiples, these price to earning and EV to EBITDA multiple for the transactions and all that, and again applied the same logic using the median numbers. I calculated the value of the firm. So for me, these numbers were a bit out, and so I didn't use. So when you use the comparable transactions, then it's better to use EV to revenue or EB to EBITDA multiple. So I here ended up selecting my EV to revenue multiple, which is over here. And on this range, I was getting a low price of $7 per share to a high price of $19.9 a share. So at that time, it was trading around 10. So I looked at it, and I then made my decision based on looking at all of these different uh, valuation methods which I used. So we create something which is called this football field. Okay, let me just close this. So in the football field, it showed me different valuation ranges. So what is the comparable transaction range was in billions of dollars, 3.1 to 8.8. Forward multiple was another thing which I did. So it gave me a certain number. Comparable companies gave me this. And then this was my number. So I said that the value of this firm, based on all this, I assigned some weight. I took weighted average. And I said that for me, based for my analysis, the value is around 6.3 to 8.8 billion dollars. That's what I thought about this business. And based on this, we made a decision, and we actually decided to make an investment. So that's what we have, and I mean, it's not. So these templates, this is not really a template. Like there is a lot of analysis which was done by myself, and this is like some of this stuff is like confidential. So I would suggest that we shouldn't put it on YouTube internally. If we can share it with with the people who are here, that is fine with me. But I would recommend not to like put it on YouTube because it is like proprietary information.
Okay, so thanks for letting us know. We will make it private.
Yeah, that's great. Thanks.
Anybody else who have a question for Sami? I wish we had arranged it in two sessions rather than one session, but Sami did an excellent job of going on and on. And thank you all of you for staying with Sami. And I think that this is as some as Iqbal wrote that this is an excellent work, your goal. So yeah, no doubt in it.
So thanks to you guys for giving this opportunity, and I'll try to see if I can find some of these like templates, and if there is an easier template I can find, I can share it with you. But I would suggest that, I mean, for you guys, because you don't do valuation and these things daily, I would suggest that read as much as possible before you invest. Read from different sources, look at the price trends in the technical analysis, and also look at your like 10Ks, and understand the business before you invest. And don't rely on, I would say, hearsay. That, and also another thing is that people, when they make money, they tend to brag about it. I also bragged about it a little about this investment, but when we were making this investment, literally we were shaking because we were going to invest $1 million on this bet, and we had no clue what's going to happen with the airline industry. So but we were keeping ourselves knowledgeable by looking at the news, that what is happening on the bailout front, and all that stuff. And I also spoke to few people in American Airlines just to have an understanding from them that where the management is, where the management is with regards to downsizing and reducing some of the costs and stuff. So all these things, they play a role when you are valuing a company, right? So I would say read as much as possible, read from different sources. Don't just follow just one particular analyst. Some of the sources which I used were here: Yahoo Finance, CNN Money, MarketBeat, Seeking Alpha, Nasdaq, Business Insider, and on top of it, Bloomberg, Wall Street Journal, all that stuff.
Awesome. Thank you once again. Anybody who wants to ask question to Sami?
Yeah, this is Hamad. Thank you, Sami. This is fantastic. Are you tracking, or are there any other tickers that are on your radar that we should all be studying?
Well, I wasn't like, doing that very actively right now, but some of the companies, I mean, a couple of firms which I felt that, is something which I should look into in more detail, were like, I wanted to look at Tesla because I feel that it is like overpriced at this point. So I wanted to have a look at it, but I didn't get any time to get into that detail. Then another company which I looked at it was Pinterest. So Pinterest, when I looked at it, it was trading at around $20 or $30. Now it is 60 something. Another company was, which I looked at was, I'm forgetting the name. It was one of these uh, aircraft leasing firms. Uh, I'm not able to recall the name, but I looked at that. So right now I am just, staying away from this for the time being, uh, because there is also something which they call a January effect, because now the prices will continue to rise, hopefully, for like, before we break for Christmas. And then in January, a lot of people will be clearing their positions and the market will slow down. And this year, because of the transition, you have a new president coming in, so that will also have an impact. So I would say just keep tracking the market, and to, I mean, I'm not in a position to give you an investment advice right off the bat, but something is that, I mean, I would recommend that if there is a company which intrigues you, read the 10K definitely, and then read as much as possible about that company, and you will get some good insights from Yahoo Finance. A lot of people think that Yahoo Finance is a very, common tool, and people just don't, understand the importance of it, but I feel it's a very good tool. It gives a lot of information, and I have spoken to several bankers, even, working at JP Morgan and hedge funds and all these places. They also go to Yahoo Finance and have a look at it. So
All
that's
right.
what I would say. If I come across any company which I would, feel like that it's like undervalued and we should invest, I'll definitely, reach out and maybe drop a message in the group.
Absolutely, you should do that. That will be a awesome thing to do. Any other question? Anybody else?
And by the way, guys, I mean, I don't want to say it, in a negative tone, but what I'm trying to say is like I'm studying finance from 2002 when I started my degree at NAST. And then I studied Pakistani capital markets, and my research dissertation was on the market crash in 2005 and then in 2008. And I did all this analysis. So even then, like studying the markets for so long, for so many years, and working in valuations and M&A and investments, still it is very tricky to figure out what could be the best investment for you. uh, but sometimes, I mean, like this analysis has its own limitations. It gave me a range, and based on the available information, we made a decision and we invested in the company. And a very basic, like lame decision was that, I mean, you never get an opportunity to buy a company like American Airlines at $10 a share.
All right.
So for it,
I should have introduced Sami a little more in detail. I thought that there will be one slide of Sami's achievements before, but we put a whole bunch of information on the poster. But Sami definitely graduated in 2005 from NUS. He did his MBA from NBS 2007. He was head of the M&A at the largest consumer good business, and he was also part of the Islamic Development Bank Group. I think so. He mentioned some of these achievements that he did. His resume goes on and on. He also represented ICB on the investment committee, so the SME funds, approved equity, debt investment. So he has plethora of knowledge. I wish we had arranged a couple of more sessions with him, and we will, inshallah, in future. But his in-depth knowledge on these topics, I think so, will definitely benefit all of us. And we want to thank once again Sami for this highly informative session. And I will once again ask the audience if they have one last question for Sami, please go ahead. And otherwise, we will say adios to everyone. All right, apparently we do not have any other question. Sami, thank you very much.
I have, oh, sorry.
So
One
go ahead,
question, sorry, Taimur, but yeah. So since you said last question, so Sami, if you want, you were talking about how you figured out the market cap of the company, right? In another slide, like 2 slides ago, and then you figured out the range, which was your estimated range between 17.5 to 24.5 for the share value. So when you got that $9 billion after subtracting the debt as well as adding the cash on hand of $280 million, so how did you get the 17.5 versus 24.5 range? Did you just divide that number of $9 billion over the outstanding shares?
No, so basically, this table is actually structured in a different way. So this is common, right? So what I'm doing here is like I have my present value of cash flow, which is this 8.9, which is sum total of the ones above, free cash flow. Okay. So if you add this, you will arrive at this number. Then I have my terminal value. So this plus this is the enterprise value. So if you look at this Excel sheet, is 42,746. This is 42,746. But here, because the way this calculation works, the number is different for terminal value here for this, scenario. So these are like different discount rates, which I'm using to discount my cash flow. And these are like different EBITDA multiples. So there are 2 things which are happening here. This EBITDA multiple is different. It is 21.5, 22.5, 23.5, right? And as a result, my growth rate of the free cash flow for the perpetual period is different. It comes out. So there is a complex formula here. So it gives me 3.6%, 3.8, and 4%. As a result, this number changes. Okay. So it's 32.3, 33.8, 35.3. This number is constant. So when I add this number to this one, I get this varying range of enterprise value. That at 7.6% discount rate, what happens if my EBITDA multiple is 21.5, 22.5, and 23.5? So I get these 3 different valuations for the company. And then these numbers are constant because these are the numbers which are actual audited financial numbers. So based on this, so this number is basically this number at the top, 41.2 billion minus 33.7 plus 280. This one is 42.7 minus this plus 280, and this one is 44 minus 33 plus 280. So these are like my equity values. And here it is simply division. So I take this cell divided by the total number of diluted shares available, and then I get this number. This is the same. It's this cell divided by total number of diluted shares, and I get this value. This number is $10.7 billion divided by total number of diluted shares, and I get my 24.17. So if you look at this, your assumptions E92, which is the total number of the diluted shares, is the same. It's the same number. Its assumptions E92 is the cell. Assumptions E92. So what is assumptions E92? So if I click this and go back to assumptions E92, which is over here, where is the assumption sheet? I'm not able to find that, but basically, yeah, here. So E92 is the total number of diluted shares outstanding, which is this 444 point something million shares. So by the way, market cap is different from the equity value. Market cap is basically the price at that moment of a share in the market multiplied by the total shares outstanding. So that is different,
Got it.
right? This one
Yep.
is the equity value, which I believe should be the market cap, but not really the market cap, because here I'm taking the dilutive effect of my preferred stock, of my stock options and all that. So it is not really a like for like market cap,
Got it.
but it's
Got it.
pretty
Makes sense.
near to that. So that's what it is. But when I'm making my decision to invest, I'm looking at this number, implied share price, with the current market price. And then I'm like, okay, so my analysis says that the valuation range that this company is worth from $17 to something like $24 based on a DCF analysis, but it is trading at $10. This means that the market is not valuing the share, the way I'm valuing at. So for me as an investor, there is an upside and a value. So I thought it is the right time to buy the share, and we invested.
Makes sense. No, thank you very much. This is very helpful. Thank you.
Yeah. Well, so this is what we have, and I mean, I'm happy to answer any other questions if you have.